Hey everyone, I'm Wade, and welcome to Retirement with Style.
We're keeping it. We're keeping it.
Welcome everyone to Retire with Style. I'm Wade, and I'm joined today by
Alex.
and our special guest today.
Hey everyone, it's Bob French again.
Yeah, welcome back to a second episode. We have so much to talk about. On the previous episode, we focused more on what was going on with the financial markets more generally, but thinking more in terms of stock and bond returns. But Bob, we're happy to have you back for another episode where today we want to focus more on the inflation environment and really the fact that inflation is much higher than we're used to seeing in a very long time, and what to make of all that. And in that regard, getting into this, you did start discussing this in our previous episode, so maybe for those who want that full Bob experience, make sure you listen to kind of the part one of the two-part here. But, what were the issues that we were talking about last time? With inflation? Why is there higher inflation?
It's like Double Shot Tuesday. Get the lead out.
Yeah, okay. To bring this all back in here, we talked about a number of things, and, a lot of, the market stuff has really been driven by inflation. So it's kind of good to dig in to what's going on there. But the basic story is largely going to be the same and largely kind of what we expected to a certain extent. I mean, effectively, I think it's fair to say the pandemic kind of screwed everything up. It screwed up, all sorts of things, but from an economic and kind of investment or really economic standpoint here, it screwed up the supply chains, just businesses in general. We're seeing a lot higher labor costs. And that's kind of the supply side of the equation. On the demand side, people have been, basically forced to save more over the past few years. We haven't been able to go out and do as much stuff. We haven't been traveling. We haven't been eating out as much. We haven't been just spending as much money.
But do you think that's been offset by the folks that needed to, needed to have stimulus? There were some folks that suffered.
Yeah. And that also plays in, absolutely, yes. I do not want to minimize that in any fashion. What I'm looking at is simply from the straight economic perspective. We have had saving rates, just as a matter of fact, have been higher over the past, 2 years than they have been historically in the U.S. And
spending did drop dramatically during the pandemic.
I was about to say for a host of reasons, but really for one big reason. The pandemic. We haven't been able to safely go out and do as much. And Alex, to your point, that a lot of that pandemic money or the stimulus money from the pandemic, that contributed to people being able to live in a lot of cases. But in a lot of other cases, it contributed to that savings that I'm talking about. That money came in and, got put into the bank or put into their investment portfolio or wherever it went. But they didn't necessarily spend it at that point in time. And now that the economy and, the world is starting to open up again, people are looking to spend that money. They are looking to go on that trip. Maybe it's domestic rather than international. Maybe it's, the next state over, whatever it might be. But they're looking to do things. They're looking to get out and spend that money. So we're left in a situation where businesses haven't quite gotten back to where they need to be. So supply is down, demand is up, and that's what inflation is. There's more money chasing less goods. So the value of the dollar is, dropping. And that's what's going on here in terms of why we're seeing what we are. And you can spin this out in any number of ways, but that's the underlying story.
And we're going to be talking about the role of the Federal Reserve in this process and what they're doing. But one starting point maybe is a step back. The Federal Reserve seems to target inflation at around 2%. They're, yeah, somebody's echoing.
Wait, I can still hear you.
Okay. Sorry about that. So the Fed seems to be targeting inflation, say at around 2% rather than, say, 0. Why are we simply not trying to have a 0% inflation rate? Why is some inflation potentially a good thing before we get into the conversation about when too much inflation?
Yeah.
Might be a bad
So this is one that's actually a really interesting kind of macroeconomic conversation. Effectively, we do, as a general statement, actually want at least a little bit of inflation. It's effectively an incentive to keep things moving. If you can just sit on your money, well, let's actually take it the other way. Deflation. When money becomes more valuable through time, that's basically how you get some form of stagnation. When you have no incentive, or actually a disincentive, to spend your money or do something with your money, people don't. They sit on their money, and it kind of keeps things locked up. So some level of inflation is good for kind of making sure that doesn't happen and just generally keeping things moving. And in
Okay,
fact,
so-
please go ahead, Alex.
Just in case for folks listening, inflation we get. Can you just repeat the definition real quick of deflation and stagflation?
So deflation is the opposite of inflation. Deflation is when inflation is negative. So a dollar is worth more tomorrow than it is today, or next year than it is today. It buys more stuff than it does today.
And this has happened historically in the U.S. during
Yes.
the Great Depression. Earlier, it's been an issue in Japan in recent years where even just holding cash is gaining real purchasing power over time if the price level is dropping. And
It's happening in
something that
crypto, or
policymakers-
it was until recently anyway. So, but it's something that intuitively feels like it should be a really cool thing or a really great thing for people. That their money just naturally is getting more valuable. Inflation's bad, so deflation must be good. Problem is, it has some pretty nasty kind of economic consequences for the quote unquote real economy. People actually going out there and spending money and doing business with each other. It disincentivizes that.
And there's some interesting research too about businesses. Inflation can provide flexibility because workers do not like to have their wages cut. With inflation, if I just keep paying the same wage, the wage is being cut in real terms. It's losing purchasing power, but people don't usually think about that. They're focused on their nominal wage. And so positive inflation provides some flexibility to firms to just not increase wages as quickly as a mechanism to help control costs in a way that if there's deflation, they have to cut people's wages or else because the goods that they can sell, they sell for less. They've got to cut wages, but that's going to really hurt morale at the firm. And so that's another reason that policymakers like to have some inflation to just create flexibility for businesses with responding to kind of the costs and so forth of business.
So it's better to have a steady state of manageable inflation because it just helps, and which is kind of the antithesis of if you're retired and you're holding cash.
Yep.
And that's for a long time now. It seemed like the Fed had beat the inflation bug, and long-term market expectations were inflation of around 2%. There's been points in recent history where we have worried a bit that maybe this inflation was going to turn into deflation. It didn't happen. Inflation tended to stay positive but low, but it's picking up now. And so what's happening in terms of now we're seeing this higher inflation? You've discussed why this is happening, this supply and demand issue. But what should we, because inflation is now, say, over the past year, 8, even potentially 9%, should we now build in an expectation that over the long-term future at this point, we're going to be dealing with much higher inflation rates? Or how can we understand the future trajectory of inflation from this starting point?
Yeah. Yes, that actually opens up a lot of different cans of worms. So the first place I always want to start here is just acknowledging the fact that this level of higher inflation, even over a relatively short period, means that we do have a lower spending power going forward. We have less money in real terms than we did a year ago, especially with what the market's been doing. But that's a separate issue. That's last week's issue. But the question is, what do we do from here? If I've got my retirement plan, how do I adjust that? Do we just jump our inflation assumption up to 8% and rerun it and see what happens? I mean, you can do that, and if everything still kind of pencils out when you're assuming 8% inflation from here to forever, you're in a pretty good position. But probably most of us probably couldn't make that statement. So what do we do going forward? How do we kind of estimate what we think inflation is going to look like going forward? And we actually have a really good way, or at least really good, it may be overstating it, but a reasonably decent way of estimating what that's going to look like based on what the market is telling us. We have some really, really interesting tools for doing this, and what we can do is we can actually look at the spread between kind of nominal treasury bonds, so your normal treasury bonds, and TIPS, which are Treasury Inflation Protected Securities, which are treasury bonds with inflation protection built in. So we can look at the price of both of those, or the yield on both of those, and effectively the only difference is that the Treasury is now saying we're going to protect you of inflation on TIPS. So the difference in yield there is what the market expects inflation to look like over whatever the relevant time period is. So if I'm interested in what inflation is going to look like over the next 20 years, I can look at the 20-year Treasury bonds yield and the yield on the 20-year TIPS. That difference is what the market expects inflation to be over the next 20 years. So that's a really, really powerful way of kind of taking a look at how inflation is likely to kind of evolve through time. So
yeah, let's give an example, because this is an important point to just make sure it's clear what's going on. So approximately right now, the 30-year Treasury and the 30-year TIPS, I believe, like the 30-year Treasury, we'll use hypothetical numbers since we don't know when people are listening, but say 3% for the 30-year Treasury, 0.5% for the 30-year TIPS. That 0.5% is the real interest rate.
Yep.
So whatever inflation will be ends up being added to that. And so the fact that 0.5% real, 3% for the traditional Treasury, implies that the market's best estimate is the inflation over the next 30 years would be 2.5%. The difference between the two.
And when you said added to that, that means added to the TIPS yield when you get your money.
Yes, because if TIPS is yielding 0.5% and inflation ends up being 2.5%, my return is 3%. I add the inflation.
Right. The government adjusts it for you.
Yes, and then if inflation ends up being higher than expected, TIPS would do better, because if inflation ends up being 6%, I would get 6.5% of my TIPS compared to 3% for the Treasury. But then if inflation only averaged 1%, I would be getting 1.5% on the TIPS compared to 3% on the Treasury.
Right.
And so people are going, if I believe inflation will be higher than what the market's pricing in, I would buy more TIPS. If I believe that inflation will be lower, I'd buy more Treasuries. If I'm a retiree whose expenses might grow with inflation, I might lean towards the TIPS as a way to help fund that liability in retirement that's growing with inflation. But that's where the market lets us see what inflation expectations are.
I think this is an interesting point just as a general matter as well, because we just spent the last episode talking about how we don't forecast, right? And then we're making a statement that the market is telling us this. Mm-hmm. Is that a forecast? I mean, I know the answer, but is that a forecast or not?
So, and you actually bring up an interesting philosophical question here. So, I mean, in the strictest sense,
does it make a sound?
Well, I don't know about the making a sound part. Only if you're there. So if you're not, we can get in there. But, in the strictest sense, sure, that's a forecast. The difference is, we're going in and we're using the available information.
There you go.
We're looking at, we have a reasonable basis for saying what's going to happen. And that reasonable basis is we're just taking a look at the market returns or what the market is telling us. The market, the sum total of the knowledge of all of the market participants, everyone putting their money at risk is saying, hey, I think, the treasury yield is here, the TIPS yield is there. We're just saying this is what everyone else is predicting. Now,
yeah, and this is different than looking at a historical average and just saying this is so below a historical average or this is so above, it's going to regress towards a mean. This is really, you're having two sets of information, and the difference between them can be explained by the expectation of what inflation will be. That's a kind of a cool dynamic.
And it's not one person forecasting that. It's the aggregate interaction of buyers and sellers
exactly.
in the market.
Yeah, and it's important to recognize that this is also something we need to take with a little bit of humility. Alex, you made that point about humility last time round. This is something we got to take with a grain of salt. Like a lot of these types of estimates from other market data, I would be willing to say that, whatever number is predicted, whether it's Wade's 2.5 or, some other percent, we won't get that. That number will be wrong. It will be higher or lower, but the thing is, I don't know which. I don't know if it's going to be wrong because, inflation was higher than expected or lower than expected. But given our currently available information, this is about where we think it'll be.
Yeah, and there's nothing wrong with that. I mean,
Exactly.
that's what the market is, right? Everything is priced. What you don't know is the unexpected piece. It's not like a year ago the spread was 8%.
Yep. Yeah.
And so what is the market telling us right now? We've got this high inflation right now, but could you kind of let us know what the market thinks the average inflation rate will be over the next 1, 5, 20, 30 years?
And real quick, I think someone could say, no, but I want it right now, 3 years or whatever. But the reality is, retirement income planning, you're making these 20-year projections, you're making these 30-year projections. I think it's good to match expectations that are of similar time horizon.
Yeah. So, Alex just called out how historical averages aren't that useful, but let's just talk about the historical averages before we take a look at the actual numbers, just to put this stuff in context. So depending on exactly what time period you're looking at, inflation is averaged, call it 2.5 to 3% historically. As Wade's called out, inflation, depending on exactly which metric you're using, over the past, call it year, has been 8, 9-ish%. So crazy high. Not hyperinflation territory by any stretch of the imagination out there. So, don't worry about those late night ads for bullion and stuff like that. But certainly higher than we would like to see. But thankfully, taking a look at what the market is telling us, over the next year, inflation will still be a little bit higher. But we're looking at kind of, again, this is numbers based off, relatively recent yields, but call it 4 2/3% over the coming year. And then kind of coming down from there. The 5-year inflation assumption is just over 3%. Pushing out to kind of 20 and 30-year type time frames, which is where we generally kind of will look for kind of long-term retirement planning estimates, kind of where we start from there, because that's a reasonable time frame. The 20-year is a little bit under 3%. The 30-year is a little bit over 2.5%. So right in line with historical averages. So we're seeing higher inflation now, but the market is estimating, again, could be wrong, but our best information is suggesting that, once we start getting out into longer time periods, it's going to come back to about normal. It's going to come back to where we've seen it historically.
I want to drive home the point that this answers the question. It may not be to your liking, but it answers it relative to the information that's out there.
Yes.
Yeah, but and look, apolitical as it can be. And right now, by saying that, I know Bob is holding his breath. But the reality is, this incorporates but this current administration, the way we're going, who knows what the heck's going to happen? Or half of you are thinking, but we're suffering the ills of the previous administration, and that's going to take so long to unwind. Who knows what's going to happen? I get all of that. But the reality is, numbers are the numbers, and this is what we're seeing from a long-term perspective, incorporating all those differing points of view.
Yep.
Bob, Wade, do you want to maybe add to that?
Yeah, that's the point, because it's the interaction of all the market players. And if you personally believe that over the next year, inflation will be more than that 4 2/3%, and or you're a retiree whose spending need is going to be hurt more by unexpectedly high inflation instead of lower than expected inflation, that might speak to you looking more towards the inflation-adjusted bond to give you that protection. But the interaction of all the market players is showing that there's this expectation that inflation will come down over time. And then it's ultimately that forecast is wrong, but it's either going to be too high or too low. And you can think about where you need to position yourself with respect to your retirement spending need.
So it doesn't matter if you watch Fox or MSNBC. It's all incorporated.
Yes.
It is. It's got both Fox and MSNBC watchers. So
now, for a while, I'd been personally, my long-term inflation forecast was around 2%, because for a long time, that's what the long-term break-even inflation rate that we're talking about between treasuries and tips was. It does look like that number was below historical averages, as you noted. It does look like it makes sense for anyone who's making these long-term forecasts to potentially be using 2.5% to 3% as their long-term inflation assumption.
And ultimately, you can call out that this is also something where you want to be thinking about where you get most comfortable with these types of assumptions, because with all of our planning assumptions, whether it's inflation, whether it's estimated stock returns or bond returns or whatever, we're wrong. That's just something we got to accept when we put these things together. So we take this information into account. We say, the 30-year, inflation rate is probably around 2.5%. But think about how you've reacted to this past year. Think about how you've reacted to very high inflation rates. Is it something that really bothered you? And if it is, maybe push your assumptions up in your planning estimates, to kind of account for that and give yourself a little bit of wiggle room, knowing that even in a higher interest rate environment, your plan will still work. So it's always important to recognize that there's push and pull on here. We can tell you what the data is. The data is, the data. But there's always a bit of interpretation in how you implement that data.
You're absolutely right. I do have a question for Wade here, because you got to talking and it sparked two questions for me, Wade. Inflation assumptions, how you adjusted your inflation assumption based on the current environment, right? If you are a total return person, remember there's your probability based, but there's some optionality involved in that. So that means that you're willing to make changes to distribution levels, et cetera, according to the need or desire. To some extent, the moment you change your inflation levels on your financial plan, that's going to change the potential withdrawal rate that you could potentially take from a success rate standpoint if you run a financial plan and you do a Monte Carlo. And so, if you're a total return person, you better, you're signing up for, I get it, stocks will go up over the long term, but if you have this inflation kicking in addition to messing around with the stock market, it's going to play around with your purchasing power. And so that will give you sort of a moment of reorganization around what distribution you're taking. And that's not good or bad, but that's just kind of what you signed up for. That's the first point, Wade. The second one I'd like to maybe have you comment on is, we get this question a lot. Why aren't there annuities that are pegged to inflation? you know. And the reality is, look how high inflation just went. The short answer is, the way it would be priced, you wouldn't want to buy it because the insurance company would have to protect themselves from this craziness. And so the reality is, you get the best they could do is a cola, on occasion. But I'll let Wade talk about it. Do you mind just touching upon those 2 points and how they hit back on retirement income strategies?
Yeah, so the higher the inflation assumption, that's a more conservative assumption because it means all of your expenses will be growing at a faster clip. Your Social Security will also grow faster as well, but usually you have less inflation-protected income than you have potentially expenses that grow with inflation. So higher inflation will put your financial plan in a worse position. It would lower your probability of success unless you're just generally somehow assuming that market returns are going to grow in line with inflation, which it's really the real rate of return for the financial plan that matters. And if you simply keep the same nominal investing return assumption but increase the inflation rate, then you are lowering your real return assumption, and therefore you're going to have a lower probability of success if that's the type of financial planning calculator you're using. Now, on the annuity question, it's right, there's no commercially available income annuity that grows with the consumer price index. There has been in the past, but it's hard for insurance companies to hedge that inflation risk they can up to 30 years, because the insurance company could use Treasury inflation protected securities, but those only go out 30 years. And to the extent that they're going to have individuals in that risk pool who live more than 30 years, especially if we're talking about like a deferred income annuity or something like that, there's no way for them to safely hedge that inflation risk. And so then they have to build in, if the market believes inflation is going to be 3% over the long term, they're going to have to work from the assumption that inflation will be 4 or 5% just to help manage the risk they're taking. And then that does lead the pricing to not look as good, because then you could compare that. Well, the market thinks inflation is going to be 3%. I could buy an income annuity with a 5% COLA that costs the same as the consumer price indexed version of the income annuity. And there just didn't seem to be a big enough market to support people wanting to use that more expensive CPI adjusted income annuity. So that's why we don't see those on the market today. But in that context, though, so how can we protect a financial plan from inflation? Like, what are the different options that we have? And Bob, we've been talking a lot about tips, so maybe we could start with one.
Start with the thing that's specifically designed to do that. Yeah, that's a good place to start.
And don't forget its cousin. Could you also talk a little bit about the I-bond side of that equation?
Yeah, and if we didn't talk about I-bonds, I know from all of you, we would definitely hear about it.
I think it's right now. This is not investment advice. Caveat: it's a good deal right now.
Yeah, I-bonds definitely have some very attractive rates on them right about now. Obviously, just to start with I-bonds, to go along with that really attractive set of rates on them. There's also some pretty significant limitations on how much you can go out and buy. There's, what is it, 10,000 per Social Security number, and then I guess we're after tax day right now, but you can also get another 5,000 from any refund you might have on your taxes. I think theoretically that number will adjust through time, but that's where it is right now. So depending on what your portfolio looks like, that 15,000 or 30,000 if you're married might not get you all of the inflation protection you're looking for, but over time you can build that up pretty substantially. So that's a really, really great option. It's one of those that the best time to start that was 5 years ago, or today is the second best time. But moving back over to tips, like I said, those
just
are
another comment on the I-bonds. And so the way they work is it's like a savings bond, and it's paying.
It is a savings
bond. The issued 0% real interest rate plus inflation. So that's why, with inflation being 8 or 9%, what you see in the news is I bonds are currently returning 8 or 9% because they'll continue to provide a real interest rate, which right now would be on currently issued ones 0, plus the inflation experience. There is some liquidity constraints. If you do put your funds into those, you can't get them back for at least a year. For the first 5 years, there will be an interest penalty if you want to redeem them. But then they continue to pay interest for up to 30 years, and it's all tax deferred as well. And they stop paying interest after 30 years, so there's not much point in holding them beyond that. But they're that inflation protected asset. It's just the limitations on how much can go in. And also they don't have the interest rate risk, unlike TIPS. If interest rates go up and 20 years from now you want to sell your I bonds, you don't have to worry about a capital loss. But yeah, it's a great tool. But now let's get into the TIPS.
Yeah, and actually, Wade, since you brought up the tax piece there, one of the other advantages that it feels weird to describe this as an advantage, but you have to buy them in your taxable account. So now you've effectively moved some of that tax deferral out of your IRA into your taxable account, meaning that you have more tax deferral than you would have otherwise on an asset that could theoretically have been some pretty gnarly from a tax perspective. But moving back to TIPS, actually this is the one that gets pretty gnarly from a tax perspective. But TIPS, or Treasury Inflation Protected Securities, as we've been talking about, are things that are very specifically designed to, protect you from inflation. They're treasury bonds that are going to pay out effectively a real interest rate. They're going to be adjusting based on what happens with inflation. And they actually adjust the principal. So they keep a constant kind of coupon rate, but they adjust the principal based on, if inflation goes up, your principal goes up, so that your coupon payment will kind of keep up with inflation, if you will. They're really, really great tools. And I mentioned the kind of tax implications. They're ones from an asset location standpoint. You really want to stick those in your tax deferred account as fast as you possibly can. From something called phantom income, where you get taxed on that principal adjustment in the year that it happens, irregardless of whether you sell it or not. That's just income to you, according to the IRS. So those are really, really great tools. And, as I think it was Alex, you made this point, even better than just dealing with the expected inflation, TIPS allows you to protect yourself, and I bonds as well, but TIPS allows you to protect yourself from that unexpected inflation. So Wade called out that, last year, year and a half ago, or whenever you want to look, the spread between nominal and TIPS, or nominal treasury bonds and TIPS, was not 9%. A good slug of this was kind of that unexpected part of inflation. TIPS would have protected you from that, at least for the portion of your investment, or a portion of your money that is in TIPS. So those are really, really great tools from that angle. I called out the expected inflation piece, though, and there's a lot of other ways to deal with that. One of the classic ways is actually short-term bonds. If you're owning just regular bonds, whether that's in an individual, just single bond, or a bond fund, inflation assumptions are baked into that price. And one of the advantages of short-term bonds is they're constantly rolling over in a short-term bond fund. So you're constantly bringing in that new information and protecting yourself from that expected level of inflation. It's not going to do anything about that unexpected inflation, but that expected inflation is built into the prices there. Same with stocks.
And there's a nuance to that. I mean, it can take, if inflation's 8% right now and your short-term bonds yielding 1%, you've got a negative 7% real return. But at least when inflation picks up, we worry interest rates will go up. And as we were talking about in last week's episode, if you have longer-term bonds and interest rates are going up, you have those capital losses that you avoid with the short-term bonds. And then over time, your point of interest rates on the short-term bonds will come up as well.
Yeah, I think big picture, you have more reset opportunities.
Yes.
When you're with short-term bonds. And this, because I don't think we described it enough, but because I'm thinking interest rates and short-term bonds and what guides. What does the Fed set this, or does the market does the Fed lead the market, or does the market lead the Fed in terms of bond rates, or what the Fed's mandate? And I know we're kind of like doing what can you do to protect yourself, but I think it's just
that's an important conversation.
A quick minute to maybe.
Yeah, so the Fed, it's a little bit chicken and egg, but I think it's probably more.
Who's the chicken?
I don't know the right way to describe it. But, so the Fed actually, they don't set. We talk about the Fed setting interest rates. What they set is basically the overnight rate that banks can lend to each other. Effectively the true risk-free rate. And then, everything gets layered on top of that. So, if you're going out and buying, a money market fund or just a general short-term bond fund, that's purely market-driven, layered on top of that really short, really safe, risk-free rate. So the Fed has enormous influence. I don't want to kind of downplay that, but last time, as we talked about as well, they have the immediate influence. When the Fed raises interest rates, when they raise their overnight rates, that they actually have some control over, and then they also have their open markets. They are in the bond markets buying and selling stuff. But when they set their rates, the market will move based off of that new information. But those moves don't have kind of longer term impacts. Knowing that the Fed raised interest rates last month doesn't tell you what's going to happen in the markets next month, or at least not to any meaningful degree, I should say. So, the Fed definitely does have an impact here, and the Fed, I think we haven't talked about them too much, but they have kind of a dual mandate. Since we're talking about inflation, one of those mandates is to manage the level of inflation in the economy. The other is to manage or to keep unemployment relatively low or keep employment relatively high, whichever way you want to phrase that. And they can manage the level of inflation to some degree through monetary policy, which is managing these interest rates. And by raising interest rates, they're effectively taking money out of the economy. They're making it harder to borrow money, harder to spend. So the Fed, as we've seen, has been raising interest rates to combat this level of inflation. It's a question of whether they're going to continue. It looks like they are going to continue to raise inflation rates so long as inflation stays relatively high. That's going to have an impact here.
Okay, and then let's talk about stocks as well and the role stocks play as an inflation hedge, or if they play a role as an inflation hedge.
Yeah, so they're a really good and massively noisy inflation hedge. So as we talked about last time, stocks have relatively high levels of expected return to correspond with relatively high levels of risk. That's kind of the deal you're making when you're investing in stocks. Part of that is that their price will incorporate expectations about inflation, along with everything else.
You also have pricing power.
Also, exactly. That's where I was going here. So, they do have pricing power. They are going concerns. They're not just this set of contracts like a bond is. A bond, absent outside stuff, they're going to give you this amount of money at this point in time, on down the calendar. A company is, as Alex said, they have pricing power. They're going out and actually selling stuff. They're the ones, out there in the actual economy being the real players here. That's going to come with all of that power to deal with inflation and, kind of bring that back to you. Problem is, it's incredibly noisy. So, if you're saying, well, I don't want any changes in my purchasing power in the short term. I want to always just know what I got. for a whole host of reasons, stocks are not your solution there. If you're saying over the course of my retirement, I want to be sure that I'm keeping track of inflation or I'm keeping up with inflation, a relatively high percentage of stocks in your portfolio will help you do that.
Historically. And
Historically, yeah. Under your breath.
Retirement strategies.
Risk is risk. Usually it works out, just to be clear. But yeah, I guess one other thing that listeners might be thinking about is, and you mentioned bullion earlier in the conversation, but commodities or cryptocurrencies.
That's not.
Yeah, this is in the category of what is not. Yeah. Because if stocks were noisy, this is like front row at a Metallica concert, noisy.
Yeah. So crypto, whatever I say about it, it's probably going to be, the day before something different will happen in the crypto market. It's just pure and utter noise. The commodities is actually, Alex, I'm sorry, go ahead.
No, crypto right now, forget the whole, it's another currency or this or that. I don't think we're there yet. It's right now, it's just, crypto is effectively, for our purposes, high tech.
Yeah.
It's the high tech stocks within the high tech sector.
Right.
Bottom line. But gold, silver, that stuff comes up quite a bit.
Yep.
And this is where you're put 2% in your portfolio in commodities. Put 5% in your portfolio in commodities. And, like I say all the time, listen, you wouldn't put $50,000, $500, you wouldn't put $10,000 in your kitchen table, light a match to it and watch it burn and then be, no worries, no big deal.
Yeah, it's only 2% of my money. Yeah.
So why the heck would you do this? It's only 1% of my money. It's crazy.
Yeah. No, I mean, and it's a more interesting story because, even more than bonds, commodities are just things. They're literally just things. It's, a barrel of oil. It's, an ounce of gold. It's whatever it might happen to be. And, by and large, absent changes in actual practical use, the long-term expected return of a commodity is actually inflation. Again, absent, changes in, extraction or use or anything like that. But theoretically, it's inflation. The problem is that, and we've looked at this a bunch in the past because it keeps coming up, is that, one, it's so incredibly noisy. So it's got, inflation-like expected return with stock-like volatility, which is not a great combination.
So you just went from and to put that in context, stock, let's say, I don't know the actual historical number right now, but let's just annualize 10% over the last 70 some odd years, standard deviation of 17. That means it moves plus or minus 17 points on any given year, right?
Yep.
So now, stock-like volatility is that.
I saw your eye twitch when Alex made that statement.
Yeah, that's one way to define it.
Well, I'm sorry. Probability-based, caveat, etc. 100%. Wade's correct, but I'm just trying to put Bob's statement in context here. I'm in a bubble, okay, Wade? I'm in a bubble when I'm saying this. So why in the heck would you buy something that returns 3% long term with that same volatility of the stock market? And that's why it's noisy, because the dispersion moves so much that you'll invariably find a time when it moved along with inflation the way you wanted to, but there'll be plenty of times where it doesn't. And in the end, the round trip, a lot of calories for nothing.
Absolutely, yeah. And that's exactly why inflation always comes up in these conversations, because it is just so noisy that there are going to be periods where it is done insanely well. And those are the times when you hear about it, or immediately after is when you hear about it.
Yeah, exactly. But I think your point too, Bob, it's very important, because you talked about stocks being a sliver of economic value, this or that, and you said they're just things. And what that means is that they're just inputs.
Yep.
They're just things that are used to make. They don't create anything.
Right.
You know, you want to maybe talk about, other than maybe timber, but that's a side note. You want to maybe talk about like what I mean by that in terms of like it doesn't, it's not created. It just is. It's used to make other things. Those companies use them to their advantage. So this whole inflation thing, it's just get it in stocks. You know what I mean?
Yeah.
From that vantage point, if you're going to go through that trouble, but you may want
to
talk about that a little better.
Yeah, at least to a first approximation. Commodities are things that are bought by publicly traded companies. There are things that go into publicly traded companies doing something with them. That's not 100% true. There's a lot of kind of private companies that are doing it, people who are outside companies, all that type of stuff. But to a first approximation anyway, it's good enough for what we're talking about here. All of that kind of commodity risk is dispersed across the entire stock market, across the entire world economy. So, if you're going to go out and buy commodities in and of themselves, you have to recognize that you're doubling up on that risk. And you have to ask yourself, why am I the natural holder of this commodity risk? Why do I want more commodity risk than the average person? I'm sure I could come up with some scenario where that would be true, but it's probably not as common as a lot of people seem to think it is, apparently. Or at least not everyone who is going out there and buying it as part of their portfolio is necessarily one of the natural holders of commodity risk.
And Bob, since we're running on time, okay, but it's not, I get all of that, Bob. I get all of that, but you know what? This is just another currency. It's a better currency than the dollar currency. I'd rather hold gold like that because, Nebuchadnezzar did the same, and,
if
he
you're
was
taking the argument all the way back to Nebuchadnezzar, I don't know what to tell you at that point. But
no, but what do you? I just obviously
no,
have an opinion, but what's your answer?
If we're talking like collapse of civilization type situation, owning the gold ETF, that's not going to do anything for you. If you're worried about, the gold held in New York when you're in, California or somewhere else, that ain't helping you. But, one of the things you can do is look at how these things correlate with inflation. Assuming we're not talking about total civilizational collapse here, in which case I'd probably prefer, the can of beans to a bar of gold. But when you look at how commodities, whether it's gold, whether it's oil, whether it's silver, whether it's whatever, they don't tend to correlate well with inflation. So you don't tend to see, high returns on commodities when you have high levels of inflation, which is, if we're looking for kind of that direct hedge, that's what you would want to see. And we just don't see it. So, if you're looking at it again as that hedge for inflation, they're just like stocks, very noisy hedges for inflation. Again, the expected return is inflation, but the expected return is inflation. When we can get that same really noisy hedge with a much, much higher return, and with that opportunity set, I think I know where I'm going to go.
Yeah. Well, the only thing that's collapsing now is this podcast episode, right?
I think it's time to wrap things up.
Yeah, I think that's a good way to call it here.
The current events angle. So thanks, Bob, for these past two episodes walking us through what's going on, because it's a different situation. Markets are down, inflation is high, and thank you for helping us make context of everything going on right now.
Well, thank you for having me.
Absolutely.
All right, Bob. All right. Do you find it funny the way I love the way Wade's like addressing you?
Our esteemed guest.
Yeah, we speak like every day. It's just
it's a semi-formal environment here. So.
Thank you, Bob. Thank you for joining us in this very special episode of Blossom. No, thank you, everyone.
Yeah, have a great week. See you next
Bye.
time on Retire with Style.